Shoot for the skies as a day trader, or bypass leverage altogether and aim for a 10% return investing in stocks? My next guest, Will Nutting, prefers the latter. For one thing, it gives him more time to travel around the world, exploring investing possibilities, often overlooked by the mainstream. Will runs a successful fund, also Nuttstuff, a newsletter which he describes as no-nonsense, common sense, stock ideas and conclusions. Here we are in Will's very stylish home in Battersea, London, a few days before Christmas 2023. Will, thanks so much for inviting us to film here in your beautiful home in Battersea, London.
My pleasure, Nick. Great to see you.
Yes, great to see you. And I think the first question is, do you consider yourself more a trader or an investor, or would you say a bit of both?
And I think to perform in these markets, you've got to be a bit of both. And I sort of think of it as, a bit like being in a restaurant. Do you cook the food? Do you serve it? Are you the guy at the front of house? I think for me, it's when I think of the fact that I eat my own cooking and the way Nuttstuff operates is I write and I opine on markets, so 2-3 times a week. And what I try to do is to do the kind of curated narrative of the geopolitics, the politics, what's going on in markets, what the story of the markets is, and then I guess trying to understand what's moving inside indexes. And then trying to get a sense as to what's consensus, what isn't consensus, what's thematic. So it's a kind of whole hodgepodge of things. So I guess it's, on the one hand, there are trading opportunities in markets when you get significant sentiment changes like we've had in the last week or 10 days. There are other times when, frankly, you've just got to sit on your hands and go with the themes that work. And on occasion, you have to suffer the drawdowns and you have to take the pain. And those are opportunities, frankly, to increase your bets or run scared, and that's at the end of the day down to your intellectual conviction.
You run your own newsletter, Nuttstuff, and what is your audience basically, and most of it?
So the audience is really it's an interesting one because I think it's evolved. I mean, Nuttstuff is a curative. Well, the mantra behind it was to make you question, make you think, make you laugh, and make you money. Or save you money. And it came about because I had nearly 30 years of selling other people's research and trying to navigate my way around markets on the other side of the fence, as serving the food rather than eating the food. And I was always a frustrated investor because I could see the opportunities, very often in things. And so I thought to myself, well, I would start a little fund, which ultimately would be really kind of my money. And then I would try and articulate in written format what I was doing, what I was thinking. And then I did that a little bit when I was working inside investment banks. And then I found it rather fun because it was an intellectual rigor to say, okay, again, where are we, where have we come from, how do the geopolitics, the politics, what's going on in the world impact stocks, impact markets? How does that generate interesting ideas versus uninteresting ideas? And I suppose when I put the whole thing together, what Nuttstuff really has become is a letter that has politics, geopolitics, interesting factoids, stock ideas, portfolio construction, completely unpolitically correct things on occasions that aren't rude or offensive. They're just what I call, I try to be a truth seeker, awful word, but to try and seek out the truth and do some joined up thinking. So to ask your original question, and not be like a politician, it's really anyone who manages their own money or someone who has their money managed by other people who really wants somebody to almost be surreptitiously holding their hand, saying to the guy managing your money, hang on a second, why don't you have any of this stuff? Why don't you see things the way Nuttstuff sees things? And so it's giving people a few signposts on the journey of investing. And anyone really looking for those signposts. But at the opposite end of the spectrum, I have some of the very lucky and humble to have some of the biggest hedge fund managers in the world who take Nuttstuff because we cover a very broad church of the market, of what's going on in the world. And I think people like the kind of joined up thinking element that ultimately has a lot of so what in it, because I think the financial world, the journalistic world is very good at telling you the good, what's bad, and everyone's sort of cautiously optimistic. And everyone's sitting on the fence. And you say, okay, let's go. What are we going to buy? What do we own? What do we not own? What do we like? What do we not like? the world's not very good at being that binary, and I take pride in the fact that we eat our own cooking. We're cooking food every day, and as I say, so far we're 5 years. We've got sort of nearly a 5-year track record for our little fund, and it's doing really well. And by the way, this is not touting for it because it's closed. You can't invest in it. I don't want investors, but I want people to see that, again, we eat our own cooking.
Yeah, interesting. Would you say you have possibly a contrarian point of view relative to...
So I listened to Nicholas Tangen the other day. He used to work for John Armitage at Edgerton, who I think is one of the great kind of equity investors, along with people like Chris Hone. And Nicholas Tangen said, that he now runs the Norwegian Sovereign Wealth Fund. And he said, you make 90% of your alpha comes from being contrarian. And it's not about being contrarian for the sake of being contrarian. It's just that, I don't know what the actual number is, but probably 90 to 92% of equity assets are passively managed now. So think of it as the dustbins of market capitalization, okay? So if you're going to go and try and add value in the dustbins of market capitalization, you've got to have a really interesting call, or just go with the momentum. Because when sentiment changes in the market, the dustbin is where the bulk of the asset market cap is. I kind of, I can opine and think and look at the dustbins. But to be honest, what's really interesting is up until a month ago, the pint mugs and the wine glasses of market cap had kind of disappeared. So you either had dustbins or you had shot glasses. And the shot glasses were things that, to be honest, have been really interesting for us in the last sort of 3 to 4 years. So coal, written off, forgot about. No Wall Street firm could look or could invest in coal, could finance coal. No fund managers could invest in coal, despite the fact that obviously it's still powering a lot of the things that we use every day. And so we looked at coal 4 years ago and made a big call on it. And for those that followed us, we've had a great run, and I think we'll still continue to have a great run. We then looked at uranium 2 years ago. We had an initial bump up. We then had the rollover that tested everyone's resolve. I think what we see in uranium now is huge. But these are tiny pockets of market capitalization that really escape most big mainline investors. Ditto. We've been looking at cannabis and marijuana, which was a huge industry 3, 4, 5 years ago. Now again, is tiny bits of market capitalization. But surreptitiously, the politics are changing. Usage has only continued. So I think there's some interesting things. So to be honest, what we try to do again is to provide a view and a perspective as to what's going on in the dustbins, but also a lot of our opportunities I see are in the kind of some of the more special situation end of the market.
So how much of a fund would be these sort of no longer fashionable investments, like you said, coal, in your fund? Did you tend to sort of look for these neglected areas and themes that are sort of I don't think I really look at. I mean, I look at our sort of 5 or 6 thematics. So, consumption, global digital infrastructure. We then have a macro overlay. We then have, and then we have 3 or 4 other different thematics. But the whole concept behind it, I think, is to try and decide. It's to try and decide what the themes are, and then when the themes pop out, it's then a case of what stocks best retrofit the theme. And then I have a sort of special situation bit of the portfolio, and in the special situation bit, that's where we will put the kind of a play on water, some plays on marijuana or what have you, the things that I think are interesting. But on the whole, the core of the portfolio is very much long-term secular thematics that we see have got, because I don't change my mind every week or every month. And I mean, a huge amount of the stocks that we have in the portfolio we owned last year, we continue to own this year, and we'll probably own next year. Yeah. When you say themes, I suppose cannabis was a theme because of the legalization and so on, and there was a big interest in that. And
I call cannabis a sort of sub-theme. It's a sub-theme that would sit inside consumption. I don't ever envisage having 20% of the portfolio in marijuana. Absolutely not. No. definitely not.
No, it's too risky.
Yeah.
Yeah. So how else do you look for themes and identify themes? Give me another example how you go about
Well,
that.
I think, global digital infrastructure is a classic example. So behind that, I guess you've got, technology. And so the logical thing that everyone would understandably say is, well, if you look at the last, 5 years, 5, 10, 15, 20 years, and look at the technology stocks that have performed, it's all the stocks that, most of our children, and their children's children could name. I think I chose and had a perspective that I did not want to just own, the top 10 market capitalization technology stocks. I thought we could do better than that. I thought we could, generate much more alpha from owning kind of mid-cap, higher growth tech stocks, and also companies that I felt were much better run for the benefit of shareholders. They didn't have the option dilution, etc. that a lot of the big companies have. And the first 3 months of this year, that was a pretty tough place to be in terms of everything was trounced by the big 5 or the big 7 stocks. So in global digital infrastructure, what we tried to do is we tried to say, okay, very clearly everyone's focusing on artificial intelligence. So let's understand who the beneficiaries of artificial intelligence are. Logically, it's the chip providers, it's AMD, it's of course Nvidia, etc. Then what we just tried to do is to say, well, hang on, what are the laterals to artificial intelligence? Who's deploying AI from a perspective? So it's is it a Palantir? Is it does this feed into Google? Yes, of course it does. Does this then feed into internet security companies? And so what you're trying to do is you're trying to look at the food chain and the laterals. And we've just selected, to have probably a slightly bigger allocation into a stock like Intel, or a stock like AMD, or a stock like Palantir, than we have, or a stock like Palo Alto Networks, than we have to continue just to own Nvidia, which, by the way, is it's a bucket, it's a giant dustbin of market capitalization, where it's the default AI company that everyone comes to. So guess what? It's almost performing the best of everyone else.
Yeah, I mean it's almost well. There's more upside, at least from my looking at charts, to Palantir, for example, than Nvidia, simply because they slumped a bit, and now their rate of increase in terms of share values seems to be offering more than Nvidia relatively.
I mean, I think that's right. It's just when you sit down, you look at you do the value, you do the fundamental work, you do the valuation analysis. You're going to find constant pushback. On Nvidia. But the point I have is, I think trying to be too academic. I always used to remember, when we used to, sell, investment banking deals, and when I was banking, and you get these very small floats of very expensive technology companies, and and clients would ask for valuation analysis, and I rather unpolitically correct used to say, it was a bit like sitting in a strip club, asking to see the family tree of somebody. It was like, why are we trying to analyze stuff that doesn't need to be analyzed? Either you're buying a stock because you think it's going to go up to trade, or you're not. But trying to be too analytical on very expensive stocks, I think is a mistake. If your gig is detailed analysis, if your gig is genealogy or whatever it is, then you've got to decide where you want to go for that analysis. And I would say it's probably not technology.
Okay. Do you pick stocks at times because of an interest in an area, whether it's AI or anything come to that?
Totally. I mean, I find it very difficult to pick stocks unless I can really understand the real world drivers of the business. So let's just take, we've owned Eli Lilly, we've owned Novo Nordisk, and we've owned it because of, Ozempic and Wegovy. And I saw 18 months ago, various friends of mine who literally looked like, someone had, found the valve and let some air out of them, and you were meeting people who are, half the size that they were before. And you were trying to, and you look at this analysis, and then you suddenly looked at, did anyone know who Novo Nordisk were? And everyone scratched their head and went, who? This is a company, by the way, that ended up with the largest market capitalization in Europe this year. And I went and talked to people at Eli Lilly, and we got a sense that suddenly this is a complete consumer phenomenon, you know. And we were so early in the early genesis of type 2 diabetes products that suddenly were beginning to being used for weight loss. The problem was that they were very expensive. It was very difficult to get hold of them. I ended up being in South Africa last year, and I remember, you know, a girlfriend of mine bringing over going and literally buying up the inventory of Wegovy in the pharmacy in Cape Town, smuggling it over to the UK, you know, and you know, having it in my fridge, and then ended up being able to sell pens left, right, and centre to all my friends, you know, not at a profit, but I mean, I could have probably made a profit on it. Thinking to myself, hang on, we are so early in this whole process. So again, a consumer phenomenon, then understanding what the total addressable market was, understanding how early we were, who was using it because of the high prices, and then taking a view on how this whole industry will develop over the next 5 years, and seeing how brilliantly the products are now evolving to alcoholism, weight loss, etc. Now, of course, I think there will be gargantuan side effects down the line. Probably there will be all sorts of societal ramifications. But right now, you know, it's a two-horse race, and the two-horse race, to be honest, has looked super exciting. You know, so that's an example of where something came as a phenomena, and then we started to look at it from the point of view of the stocks. We got in reasonably early, and we've generated, you know, a lot of alpha from those calls.
So with Eli Lilly, for example, I mean, I remember looking at them just coming out of COVID, and they were sort of, you know, they were surviving, they were doing better than some pharmaceuticals, and then they really had this amazing run. So did you look at the charts to begin with, or did you have some sort of knowledge of pharma?
So it's an interesting question. I mean, the charts to me are part of a consideration when I'm on a journey. So, you know, there are people who can turn on their ways, and in fact have no idea of where they're going. So in fact, my girlfriend, for example, okay, she will turn on a navigation system, okay, and literally will then stare at the screen and almost think she's in a dark room, not knowing where we're going. To me, I use the navigation system as a great check. I'm listening for left turn. I'm considering that the navigation system is also looking at all it's using its technology to look at all the traffic jams ahead and other information I don't know about. But I never lose sight of the fact that the reason I'm going on that journey is because I know where I've started and I know where I'm going to get to. And the question really for me is, I would say this as an investor versus a trader, you know, bear with me on this, is it's like taking your dog for a walk, okay? If you have a dog and you put it on one of those leads and you press the button and the dog can go off for miles on the lead, and then you press the button again and the dog sort of almost springs back to you, okay? You leave your house, you go for a walk, and the dog goes off and it does whatever it does behind a car, and it does it behind a tree, and it charges around. And by the time you got to the end of your dog walk, you walked a mile and the dog's gone 2.5 miles. That to me is the difference between an investor and a trader. I want to walk a mile, and the trader wants to walk 2.5 miles, charging around all over the place, making messes left, right, and centre. But at the end of the day, I kind of figure we get to the other end of the spectrum. So for me, I believe in the integrity of the 100-day moving average. I watch stocks when they break the 180-day. Do they then break back above? If they reconfirm that break above and you get a momentum, I believe in relative price momentum. I believe in 90-day moving averages. So I look at technicals, but technicals are entirely supplementary to fundamentals, thematic, and to be honest, just looking out the bloody window at what's going on in the world. You know, look out the bloody window, excuse my French, at what's going on in the world of energy. You know, why are uranium stocks, doing what uranium stocks are doing, and why are they going to do what they're going to do for the next 2 to 3 years? If anyone understands anything about, the provision of energy in society today, base load power is what matters. We can sit and talk about wind and wave and sun and nuclear fission and all sorts of other fascinating things that everyone wants to talk about at places like COP. But the reality is, what is deliverable and workable and is required for all the things like artificial intelligence, to grow and prosper in the way that the stock's valuations imply, and as a way that everyone thinks is going to happen.
Yeah, yeah. Do you use software in any of your assessments of where markets are going, or is it just the rigor of your research?
Again, I don't use software. I mean, I don't use software to deliberate on. I use software to grind out. I use Bloomberg avidly. Just an unbelievably brilliant and incredibly expensive tool. And obviously we grind all the portfolio data on software. But as regards to identifying stocks and ideas, no. I mean, I do screening, yes. I mean, we do quite a lot of screening on free cash flow yield and various debt metrics and growth metrics. But no, I don't use software for anything else.
Do you do any trading yourself? I mean, as in, should we say, on leverage, that kind of trading, or is it everything?
So do any trading on leverage? Sometimes I have a guy who who kind of works with me, who's actually a great friend, who's based in Australia, who's an options whiz. So sometimes if I find an opportunity or a trading opportunity, and I think, gosh, I can, it's like, as again, taking the dog for a walk. I'm here, I think I can take the dog for a walk, and we get to there. If there's a 1-to-1 or if there's a 1-to-5x on an equity, but there's a 1-to-30x on in some kind of simple derivative strategy, I'm very happy to let him take a look at the same walk and deliver me a solution that might deliver 30 or 40 times, and I'm happy to share that with people. But on the whole, for me, there's normally enough alpha, and I'm not trying to deliver 30 or 40% returns a year. In a world of 5-6% rates, I want to do 10 to 15% a year is exactly where we want to be.
Yeah, and the higher you go, the more risk you take on. Of course, that's the big problem when you aim for those big numbers. Then you you have to also look what's below that.
Yeah,
which is kind of scary. What do you make? Talking about stories, possibly in a different sense from what you were talking about, but the story of the last 12 months has been really quite confusing in terms of stocks, in as much that we've had so many traders, pundits and what have you screaming pretty much every week on YouTube saying, we're in so much debt, everything is looking like 1987 and 1929, and everything is surely going to collapse any minute. So there's been this funny year of obviously we had that bear market phase previous year, but we've been steadily going up, and then faster and faster we've been gaining this crazy momentum now. Now we're coming up to this double top, talking technicals. What's your feeling been throughout that year? Have you been swayed at all by all the negative talk? Because there's been a hell of a lot of it.
No, I mean, I think, and without sounding smug, we've got to fund up. I think we're up 10.5 or something for the year, 11% for the year. And coming to October last year, I came into psychology. I thought it's been plagiarized by quite a few people, but I always try and think about how to explain things in a kind of analogous way. So I was thinking about, it was like mountaineering last year. We had this tremendous fear of inflation. First of all, I'd say fear is temporary, greed is permanent. So there's no doubt greed is that. And there's a lot of cash sitting in money market accounts. So I think the greed side of markets has returned. The fear side of it was obviously that we had very high levels of debt, very interest rates that were obviously having to go up because that blunt tool was being used by central banks very clearly. But I said that the time that, if you're a mountaineer, the time that you're thinking about your party back at base camp, if you're planning for it as you're coming down from summiting, it's almost too late. You're actually thinking about the party as you're summiting. And so as we were summiting, what I felt was rates at the end of last year. Even if we were early, my sense was that we were going to think about a party back at base camp. And my notion, the great thing about doing what I do is that, I write, it's there, I can't hide. There's a fund, there's what I've said, and I can be called out on it at any time, you know. And I try not to have too much selective memory. And so what I said was, you know, that let's think about the party. And when I add to that, I said that my sense about Western governments, and this comes to a much bigger geopolitical issue, which we can talk about, but you know, Western governments cannot and will not allow people to feel the pain they should feel. I would argue right now, with where debt levels are, with where our demographics are, with where our sense of entitlement is, with where our embarrassingly poor politics, our lack of capital spending for the last 20 years in this country, we probably need interest rates of 10 or 15% to have a proper cleansing effect on the economy. But we're not going to get it. And we're not going to get it because politicians won't allow anyone to feel any pain. So the only thing that matters for 2024, if you're an investor right now, is are Western governments going to print money? And are they going to get print money again? And if they print money again, you know as well as I do that it's crypto, it's gold, you know, it's a devaluation of Western currencies, you know, and it's hugely positive for emerging markets ex-China, and you can do that on a sort of country-specific risk, which is a lot of stuff that we've been talking about in Nuttstuff and we'll be talking about as we look into next year, you know. So for me, 2023 has been a fairly logical year. It's been tough because there's been periods when our big bets on infrastructure, energy, value, uranium have been tested because all the focus has been into technology. The good news is we've owned lots of technology and we continue to own lots of technology. We own lots of semiconductors. We just haven't owned a lot of the mega cap stocks. We own Google.
You mean the UK? When you say we, or do you mean your fund?
I'm talking about Nuttstuff as us with our fund. Exactly. Yeah. You know, I think in the UK, you know, much more difficult in the UK because you don't have such a clearly defined menu to go off in terms of, you know, mega cap winning technology stocks. So when you look at the UK and Europe, you know, UK ends up having a much bigger bias on energy, pharmaceuticals, banks, etc. Europe, technology equivalent were luxury stocks, and that's another story that I think is, you know, apart from Japan, which is a great strong story there, I think there's been some issues. There's been some bigger issues there. So, as I say, on the whole, you know, for me, 2023 has been tough but logical. And what I see now, and in terms of where our fund is moving now and how we're looking and how I'm looking into 2024, you know, it's going to be very clear to me what the signposts on that journey are going to be in terms of, you know, are we going to get more money printing? Are we going to get more excesses? Or, you know, is this recession that everyone thinks is going to appear, which I'm afraid, especially in the US, I don't buy into, you know, is going to appear. And I think if we do, it'll be very shallow.
I'd like to take you up on that word logical, because logically, at least according to the traders I've been watching, talking about the economy and the debt and so on, the logical thing should be that we have, or should have had, a deeper bear market and a slower pulling out of that, if not even a crash. So with all this debt and the combination of debt, high interest, and geopolitics...
But I don't buy that, because look at where the market capitalization is in the market, okay? Go and look at where the index weightings are. And then again, go and look out the window. So wander around London or get on to Expedia and try and find a hotel room in London, or New York, or Singapore, or Tokyo. Trying to find a hotel room in London in a top hotel, it's £1,500 plus a night, okay? Go and look at the major technology companies. Again, let's talk about Nvidia, AMD, Intel. Look at their top lines. So psychologically, everyone was talking themselves into this recession. And what's extraordinary is that, and I wrote this last week, I said, you know, the people trying to end the party, the people who never even showed up at the party in the first place. They sat there in cash talking about recession, without understanding that, you know, yes, I mean, this goes to my point about the US, which is that, let's just talk about America for the time being. You know, the people talking about recession look at the excesses in New York, the excesses in Miami, the excesses in Los Angeles, the misery of San Francisco, which I know something about because my children lived there for a long time. And trying to understand that declining, as you move from a world of 20 years of free money, which is when people buy lottery tickets and fund dog walking apps and all the things that we know, we work, you know, we rubbish, whatever you want to call it. The flip side of it is when money now costs something, the good news is that savers end up with, a decent return on their money. You can go and buy you can get a 5 or 6% yield from government debt. So if you're going to go and swing the bat in equity markets, you need to have a 10, 15% return, which is, I guess, where we hopefully try and come in with how I look at things. But the flip side of it is when people talk about the recession, in America, if you go into the middle of America, forget about the coasts, look at middle America, look at the defense and aerospace industries, look at real world industries. When we came out of COVID and all the free money that was given, people who've gone back to work in middle America have not gone back to work for a 30% upgrade in wages. They've gone back for a 100, 200, 300% return on wages. So yes, the cost of living has gone up, but look at wage inflation, and so I think in the UK, everyone's focused on mortgages and household without actually looking at doing the analysis on how many people actually have floating rate debt and how many people in the UK live debt free in terms of housing, And secondly, there's a whole swathes of the economy where you've had huge wage inflation and you've got full employment. And as a result of the digital economy, lots of people have 2 or 3 jobs. And so, again, I think if you look out the window, there are certain parts of the market and certain parts of the economy that very logically have been hurt by a movement from free money to a world where money costs something. But in reality, so far, I've seen much more to be positive about and much more to reflect on the resilience of than I have things to worry me. So, as I say, I look at some of the craziness of private equity, as something that potentially I think is really vulnerable. Although obviously, if interest rate expectations begin to fall, that they get bailed out, So that's an area that I think, obviously is of concern. Real estate we've talked about, but there's whole other swathes of the economy in the world of technology that's just hugely exciting with massive efficiencies and massive opportunities. So I'm afraid logically for me, I didn't ever think that I never bought into this whole notion of a deep aggressive recession.
No, it's interesting, isn't it? I think also a lot of that, going back to your you're mentioning stories, and I think that also goes to mindset as well, and the kind of stories you look for. And I suppose if you are a little bit more pessimistic, you're going to run with all that kind of data that suggests an end of day scenario. It's just.
But also, Nick, the market's a discounting mechanism. So it goes back to what I said about my mountaineering analogy, which is that you're trying to invest not on where the puck is or where the puck is going. So when you look at the market today and you say to yourself, if sentiment is right and inflation is moderating, I would disagree with the Prime Minister and the Chancellor. They have not halved inflation. The £110,000 Range Rover that now costs £180,000 is not going back to £110,000 anytime soon. So that's the persistence of higher prices. Wage growth is not going to be dialed back to where they were 2 years ago. So the persistent inflation, but the delta of change is what has moderated. So if that delta of change has moderated and we've gone too far on rates, well then the discounting mechanism on that of, oh gosh, there's a chance that my borrowing, my mortgage debt, my corporate debt will not be as expensive in 12 months' time, 18 months' time, as I think it will. If we then get some kind of resolution, political resolution, with the regime change that we're going to be seeing in Western governments over the next sort of 12 to 18 months in the US, in here with the general election, if we've got any sentiment of a more business-friendly, less nonsense in politics, that's hugely positive for equity markets. It's hugely positive for you've just got to work out which parts of the market that's particularly positive for, and which parts of the market it's baked into.
Yeah, ironically, it's we're almost, the Conservatives are, at least traditionally, the friends of business, but you get the feeling at this point in time, the prospect of Labour, if nothing else, would bring or get rid of some of the silliness, and investors might take a second look at the UK and push the Brexit worries to one side and actually come and invest here more?
I think that's right. I mean, I think you look at how cheap and undervalued UK companies are. And what's
look at Shell. It's down there.
That's a bigger issue with not incentivizing companies to go and spend. This is, what the energy companies are doing, why they trade, some of them trade at the valuations they do, is a much bigger issue about how governments have approached the whole environmental energy policy. And if you'll indulge me for 2 seconds, I think it's quite simple, which is that if you're talking to children, you're talking to teenagers, you're talking to your children about where you think the world should be in terms of a carbon-free, more environmentally friendly energy. That's the other side of the chasm, and let's work out whether we can get there by 2050. Frankly, I think no cat's chance in hell, unless you want to condemn the next 3 billion people joining the world's population to poverty. I don't want to do that, and I don't think most people want to. But the problem is, we are where we are. We've spent what we spent, and we have to understand where fossil fuels are in terms of fueling the Western economies as they are. The problem is there's a bridge across the chasm, and the bridge is made of fossil fuels. It's also maybe made of some wind and some wave and some solar and such like. And the problem is we haven't invested in the bridge. And so I always say to people when I talk is that it's a bit like going to school sports day, which is that if you go to school sports day, the governments have rewarded the really well-behaved kid with the Pebble Dash glasses who won the science prize in his first year, and he keeps winning the science prize every 5 years. The most important prize and the most important pupil, to my mind, to incentivize, is the badly behaved child who had a really big following, who, if he becomes better behaved, completely changes the sentiment in the school. So the school bully who gets religion and understands that bullying isn't cool and starts to become a force for good should be rewarded. And so when it comes to the Shells, the BPs, the ExxonMobils, the Occidentals, who are going to materially change their business models and start to do better things, there should be massive incentive there. It shouldn't just be, we're not going to punish them anymore. It's not about punishing them. No. It's actually about giving them massive incentives. And of course, politically, it takes intelligent, articulate people to stand up in front of the electorate and say, listen, this is not about enriching executives of BP and Shell or ExxonMobil. It's just a simple case of psychology and understanding that if you are the chief executive of a company, you either have capital spending to do, or you just take your free cash flow and buy back your own stock and do what you do. And you can't tell chief executives, unless you want to go to some kind of communist regime, you can't tell executives what to do. You've got to incentivize them. I always say, with a seal, if you want a seal to bounce a ball on the end of its nose, give it a fish, don't beat it with a stick, right? And so we've got to start giving corporates fish,
Yeah, it's completely missing from the political narrative, really. You'd think it was a no-brainer for the Conservatives, but they just make a mess of it.
Well, I think the Conservatives. The Conservatives spend an enormous amount of time focusing on trying to get people to vote for them who will never vote for them, and I just don't understand why you would spend any time doing that. And at the same time, they seem to do a brilliant job of alienate the people who naturally would vote for them. So, I think probably to your point, it's not a bad environment to give the other team a go. And I think that that age-old expression of you campaign in poetry and you govern in prose. I think governing in prose. I don't know Keir Starmer. I've met Rachel Reeves. I've met Wes Streeting. I've listened to Wes Streeting talk. I think they're sincere, intelligent people, and I think they have a plan. And if they don't have a plan, they're completely bonkers. Because right now, if they had a plan, and they could wake up one day and articulate what the Conservative Party don't seem to be able to articulate, which is what are the 5 reasons why it would be better waking up in the UK under a Labour government than it would be under a UK government. If someone could actually come out with those 5 bullet points that some guy driving a van or running a shop or running a small business could understand and could repeat, I think we'd then have a chance at some kind of a decent political process. But right now, I don't think anybody knows what anyone stands for.
No, exactly. Well, I'm going to deviate a little bit from our politics because we could go on all morning, if not the afternoon. But I'd just like a little bit of a glimpse into your daily life. You know, what is you're doing the newsletter? What are the other activities you?
I spend my entire life meeting and talking to people, which is exhausting, but it's also, you know, humblingly interesting. I travel a lot, so because Nuttstuff is a global product, I'm constantly trying to look for. First of all, I have, you know, readers and subscribers in a lot of places in the world, and also I think it's incredibly important to do your own primary research. So this year I was in South Africa, I was in Namibia, I was in Kyrgyzstan, I was in Mongolia.
Was this your coal venture?
This is looking at lithium, actually.
Okay.
Looking at lithium. Lithium, and actually what came out of it was not lithium. What came out of it was actually fascinating opportunities in hydro. Just to name a few places, and I'm going to Japan and Hong Kong very early in 2024, and I'm going to try and go to Australia as well, which I have been to before. But to me, it's going there. It's having the ability to go meet the odd person in government. You know, I was in Namibia. I wandered around Walvis Bay. I saw the ports. It gave me a huge insight into the explosion in offshore drilling that's going on in southwestern Africa, but also the contrast of Namibia with political and tribal stability, a great relationship with the Chinese invaders, as everyone seems to think they are, which they're not in a place like Namibia, was really fascinating. And so when I do that, what I try and do is just write a kind of, you know, quick hatchet job, sort of an Adrian Gill, hopefully Adrian would have done it much better than me, God rest his soul, but a sort of Adrian Gill kind of, you know, quick snapshot of a country and why it's interesting and what the opportunities are. And then I just try and dovetail that into a macro overlay in our sort of the portfolio to try and say, this is why this particular country is interesting, and this is the so what reflected in an ETF or a specific equity position or what have you. So for me, it's a lot of travel. You know, I have two daughters who live in America who are at university, who I try and see a bit of when they're not too busy to see me. I have a family here, but I write twice a week, but it doesn't mean I just sit down for 2 hours and vomit into my laptop. It's a constant input of dialogue, and why I think Nuttstuff can continue to do what we do is not just because of me, because we've got a great team. We've got a great team of people. We have some incredible inputs
here in the UK or all
over the world. And then we have sort of 4 or 5 people who regularly input stuff to me, who are old clients of mine, who are friends, who become really good friends, and we bounce ideas around. And what I've discovered from doing this in the last 3 years properly is that there's a humblingly bright collection of people of between 40 and 60 who have made a ton of money in the financial services industry, who are now sitting in holiday houses, ski houses, houses by beaches, houses at the top of mountains, who spend their life looking at markets and are investors. And they may not all want to be quoted in person. In fact, very few of them do. But they're all very willing to share their insights, their thoughts, their conclusions on what they see. And so part of what I do, to be honest, is I'm a recipient of a lot of views and thoughts. And I guess if there's a sort of skill to what I do, it's taking our own views, our own thoughts, our own inputs, and our own perspective and template on the market, taking in other people's really smart views, and ultimately reflecting them. And then when we come up with the best way to reflect a view in one of the thematics, what I'm trying to do is to try and decide, the best way of doing it, whether it's in an equity or whether it's, something a bit more esoteric as an ETF, or might be, as I talked about earlier, there might be some kind of a basic derivative trade that we could do as well.
Have you ever been on a trip and thought, oh wow, I've just discovered something really that's going to change my folio, ideas at least, and come back and within a few months seen that come to pass, if you like?
So I'd say when I came back from Namibia last year, I I absolutely doubled down on all our offshore exposure. So companies like Tidewater, on companies like Valaris, companies like Transocean, and I think that was my real sense was suddenly realizing that deep water offshore oil was going to be a big secular growth story, and the market's jury is still out, but I'm convinced that's a great place. I then went to Finland last summer actually, and not really investable, but I went to stay with some great friends, a friend of mine who's sort of Danish and has a house in Finland, and my overriding impression was if the balloon ever goes up, I'm going to take my big truck outside and I'm going to drive to Finland, and I'm going to spend the last 20 years of my life with a box full of books, sitting on an island in Finland, and no one will ever find me. So in terms of strong conclusions from places I've been to, yes, absolutely.
Good, Will. Thanks for talking to me.
Great to chat. Thanks.